In 2019, one strike raised 5.7 million barrels a day, the biggest oil outage ever. But there is an even bigger strike that, if it happened, could take out 20% of the entire world oil. If Iran wanted to hold the world hostage, how will it do it? And could it do it really? Not with missiles, but with a map. One narrow passage, the Strait of Hormuz, trodden by mines, drones, and quiet ship seizures. War risk insurance doubles, tanker counts thin, Brent time spreads snap tight. With Russia hemmed in by sanctions, U.S. shale unable to surge on command, the replacement barrels don't arrive in time. That's when prices become policy and Tehran holds the pen. How quickly do navies, OPEC spares capacity, and strategic reserves really matter? And what's the one metric you should watch to know it's starting? Let's dive in and find out. My name is Dr. David Oualaalou, and you are watching Geopolitics and Money. Follow the money, decode the world. Let's take a deep dive into the trigger, the Strait of Hormuz. Why the Strait of Hormuz matters. The Strait of Hormuz is the world's critical energy choke point. In 2024-2025, 20 million barrels a day of crude and products, about 20% of global petroleum liquids consumption, transited the strait, and roughly 20% of global liquefied natural gas, LNG, primarily from Qatar, also moved through it. In short, even a brief disruption can ripple through oil and gas prices worldwide. Can Iran really close it? And who decides? Tehran has periodically threatened to shut down the Strait of Hormuz, but under Iran's system, the final call rests with the Supreme National Security Council and ultimately the Supreme Leader Ali Khamenei. In June 2025, aimed escalation, Iranian media and officials reiterated that any closure will require SNCC approval, highlighting both the political bar and the seriousness of the debate. What is Iran's playbook? A tanker war without a declaration? A full lasting closure is hard, but mines, drones, missiles, strikes, and ship seizures can produce a massive market shock. More on that later in the show, because as you will see, one small strait closure can affect most of the world industries, not just oil. Analysts warn Iran retains enough asymmetric naval power to harass traffic and raise risks as seen in the 2019 Gulf of Amman attack and subsequent incidents near Oman. U.S. commanders recently told Congress they are watching precisely these tactics. When tensions spikes, war risk insurance and related costs jump long before a shot is fired. In late June 2025, premiums for Middle East Gulf sailing rose to between 0.15% of whole value, up from 0.2 to 0.3%. Adding tens of thousands of dollars per voyage, we saw similar surges after the 2019 tanker attacks. Those costs feed directly into delivered energy prices. Now let's look at the market shock channels, energy and shipping. Oil and liquefied natural gas shock versus what is the well-supplied baseline. The International Energy Agency, or IEA, mid-year outlook projects supply growth outpacing demand in 2026, implying ample spare capacity and an easing backdrop. Unless geopolitics-driven outage hits, That's why the Strait of Hormuz scare matters. It can flip a well-supplied baseline into a price spike in days, especially if insurers and shippers pull back. The real-world analog, Red Sea reroutes. We've already seen how a security shock cascades through shipping. After Houthis or Ansarullah attacks, carriers diverted around the Cape of Good Hope, adding 10+ days to Asia-Europe trips on average and pushing up costs and emissions. By October 2024, travel distances had risen about 48% for container cargo and 38% for tankers that previously used the Red Sea route. That's the template for a Hormuz scare. Longer routes, tighter schedules, and yes, higher delivered prices. What do carriers do under risks? Top lines like Maersk publicly said they will keep rerouting around Africa through 2025 unless security improved. And investor reports from peers, example, Hapag-Lloyd, flag the Red Sea as an ongoing operational and cost headwind. One reason spot and contract rate whipsawed this year, they spiked, then eased, but remain volatile by trade line. Expect the same playbook: reroutes, surcharges, schedule changes if the Strait of Hormuz risk escalates. LNG magnifies the pain, Asia and winter Europe. Strait of Hormuz isn't just oil. About 19% of global LNG transit the strait, including 94% of Qatar's and 100% of the United Arab Emirates LNG exports. Flows that are heavily Asia-bound and crucial to Europe's winter balance. Even a short disruption forces cargo deferrals, repricing, and a higher risk premia across gas markets, with limited bypass capacity compared to the volumes at stake. Next, from oil shock to financial contagion. Let's look at derivatives, margin calls, liquidity squeeze. A sudden price spike from the Strait of Hormuz disruption wouldn't just hit spot barrels. It will ripple through energy derivatives. When prices jump, clearinghouses raise variation and often initial margins, forcing utilities, traders, and producers to post cash quickly. We saw this movie before in 2022. Evidence that a sharp oil shock can create a margin spiral that spread beyond the oil patch. Let's look at the non-bank finance as the transmission belt, because a big share of commodity risk now sits outside banks. Stress can travel through non-bank financial institutions like hedge funds, commodity merchants, clearing members. Supervisors warned in 2022 that surging margin calls produced acute liquidity strains for energy firms, while banks' ability to extend credit was limited by risk limits. Exactly the transmission line that could turn a Strait of Hormuz supply shock into a broader funding squeeze. What about inflation, growth, and policy reaction? That's a good question. Oil shocks still pass through to inflation and activity. How much depends on the country's structure and policy response. IMF, or International Monetary Fund, and Fed research show sustained oil spikes can lift headlines and even core inflation, dent output and employment, especially in oil importing economies. and of course complicate central bank choices, turning a supply shock into a tighter financial conditions. If the Strait of Hormuz derives a durable spike, expect higher inflation, print a tougher trade-off for monetary policy. What is the cash flow shock for the real economy? Even without a total closure, elevated risk around the Strait of Hormuz can hike war risk insurance and freight rates, slow sailings, and extend transit times, tying up inventory and cash. That was the pattern after Red Sea disruptions: longer routes, higher costs, and working capital stress for shippers and cargo owners. Layered on the top of pricier energy and derivatives margining, these logistics frictions amplify the corporate cash flow crunch, another path from an oil shock to financial strain. Now, let's examine Iran's playbook beyond the Strait of Hormuz. First, proxy warfare at sea, Red Sea, Suez as the template. Iran can outsource disruption to partners. The Houthi campaigns in the Red Sea shows how drone, missiles, harassments, seizures, and occasional sinkings can append a global schedule without a formal war. Since late 2023, Ansarullah or Houthis have targeted 100 plus merchant ships, sinking several and forcing widespread rerouting, with analysts mapping clear attack patterns and escalation risks through 2025. The spillover is visible in European ports data as traffic shifted to longer Cape of Good Hope routes. Second, striking infrastructure to remove supply overnight, like Abqiq or Khorais. Beyond harassment at sea, Iran or its allies can hit energy infrastructure to create immediate supply shocks, as in September 2019, when precision strikes on Baqiq and Khorais temporarily knocked out 5.7 million barrels per day of Saudi output, which is about 5% of global supply, the largest single-day outage on record. Production was largely restored within weeks, but the episode proved how swiftly a well-placed strike can move prices and unsettle markets. Third, threats alone can jolt markets, especially around the Strait of Hormuz. Congressional researchers note that even threat-driven partial interruptions, not just full closures around the Strait of Hormuz, can lift oil and LNG prices by hiking war risk insurance, discouraging sailings, and tightening supplies. With limited alternate routes to move Gulf crude and gas, any elevated risk near the Strait of Hormuz amplifies price volatility well beyond the region. Now, let's look at the counterweight. What decides collapse versus shock? First, bypass capacity helps but can't replace the Strait of Hormuz. Saudi Arabia can push crude west via its east-west petrol line to Yanbu, which is about 5 million barrels per day in a normal operation. Briefly, about 7 million barrels a day in 2019, when Aramco reconfigured any GL lines. The United Arab Emirates, Habshan, and Fujairah adds about 1.8 million barrels a day outside the Strait of Hormuz. Useful, but still small, versus the 20 million barrels a day that routinely transits the Strait of Hormuz. So any serious disruption still bites. Second, spare capacity and strategic shocks cushion shocks. up to a point. The IEA, the International Energy Agency's August 2025 oil market report, still sees supply growth in 2026, meaning some buffer exists if a disruption is brief. Saudi Arabia plus United Arab Emirates hold the lion's share of OPEC's plus spare capacity. But Reuters notes this could add 3.5 million barrels per day at most, largely exhausting the cushion if deployed. On top, governments can tap strategic stocks. The U.S. SPR, Strategic Petroleum Reserve, sits around 403 million barrels as of August 2025, giving Washington room for targeted releases. Third, price paths from scare to spikes. How high and for how long? Analysts handicap outcome from a transit scare to a temporary blockage. Goldman Sachs has flagged Brent near $110 if flows through the Strait of Hormuz are blocked. JP Morgan has modeled $120 to $130. That's the price for a barrel of oil in a sharper case. Many expect any sustained closure to be hard to maintain and politically costly for Iran, implying spike and fade dynamics, especially if spare capacity and stocks are mobilized. Fourth, the real deciders: insurance, navies, and diplomacy. Even without shutdown, war risk insurance can jump fast to about 0.5% of whole value in June 25, adding tens of thousands of dollars per voyage and lifting delivered prices. Whether a shock becomes a global financial event or a contained energy spike hinges on naval escorts and mine clearance timeline, plus a rapid political de-escalation. CRS underscores that even a threat-driven partial interruptions around the Strait of Hormuz can jolt markets, while swift response can cap the damage. In the end, the Strait of Hormuz is the spark, but the fire spreads through insurance, shipping routes, and margin calls. Iran does not need to close the Strait of Hormuz to rattle the system. Threats, harassment, or one well-aimed strike can lift war risk premia, reroute tankers, and force cash into derivatives margin just as energy prices jump. That's how an oil shock becomes a financial shock. Cash gets trapped in collateral at the exact moment companies need it for fuel, freight, and inventory. Whether this becomes a global economic event or a contained spike depends on four clocks. 1. How fast naval escorts and mine clearances restore confidence. 2. How much spare capacity and strategic stocks governments unleash. 3. How quickly insurers cut risk, surcharges. And 4. How soon diplomacy cools escalation. If those clocks move in time, the outcome is a bruising price shock. If they don't, the pressure leaps from barrels to balance sheets, and that's when the markets wobble. In short, Iran doesn't need to shut down the Strait of Hormuz to shake the world. Credible threats, proxy strikes, or a single precision hit can spike war risk insurance, reroute ships, and yank cash into margin calls just as fuel and freight costs jumps, turning an energy shock into a financial one. Whether that's become a brief bruise or a break depends on how fast navies secure lanes, how much spare capacity and strategic reserves are released, and how quickly diplomacy cool things down, because in this silent war, the real battlefield isn't just barrels on the water, it's balance sheets under stress. This is more reason than ever to put peace and diplomacy first. Thanks for watching, and we want to give a shout out to our Patreon members. If you want to join our Patreon to support our work and get exclusive content, check it out at patreon.com/GPIC. And remember, follow the money and decode the world.